Now, Indian bonds have been included in JP Morgan's Emerging Market Index. But what does that mean for Indian investments and its larger economy? Take a look at this next report to find out.
In exciting news for India, JP Morgan is including Indian bonds in its Emerging Market Index. The JP Morgan EM Index is like a big list that shows how different countries' bonds are doing. It helps people decide where to invest their money. Now India's bonds will be a part of this list, and that's a big deal. When India's bonds are in this list, it means more people from around the world will want to invest their money in India. The Indian rupee has been having a tough time because of rising oil prices. But with more foreign investments, the rupee can become stronger, which is good for the country. When more money comes into India, it can make the economy more stable. This stability can make Indian assets, like stocks, more attractive to investors. India can borrow money from other countries through these bonds. This is like taking a loan, but it can be a good thing because it gives India more choices for financing. Businesses in India can also benefit. With more money flowing into the country, companies can get the funds they need to grow. So, in simple words, JP Morgan's EM Index is like a VIP list for countries' bonds. Being on this list means more money coming into India, which can help the country's economy and make its currency stronger. It's like a thumbs up for the India growth story and its economy. Bureau Report, WION, World is One.
And for more insights, we are being joined by Professor Suyash Bhatt, Director, Academy for Finance, Technology and Innovation, is joining us live from Dubai. Welcome to the broadcast, Mr. Bhatt. I would like to begin by asking you, how do you foresee this inclusion impacting India's long-term fiscal policies and debt management strategies, also considering this was a much-awaited and anticipated inclusion?
Good morning. I believe you captured it perfectly. India was the only emerging market which was not included in this global bond index that is there. And it's a very significant move. Globally, if we see, there are three major indices which investors follow. And one of them is JP Morgan Index, and the second one is Bloomberg Barclays Index. And the third one is FTSE Russell Index. So this is the first move that is done by JP Morgan, where they have a GBI EM Global Diversified Index fund, which is of 213 billion US dollars. And they have included India, and they have given 10% weightage to India. So it's a very significant move, 10% almost. 21 billion US dollars you can expect to enter India anytime soon. The date given is June 24, and it will happen in a gradual manner. So this impact you would see in next 12 to 18 months. And other funds, the other two funds also would be now looking at including India, and that makes the total kitty of funds coming to India reaching up to 40 billion US dollars in next 12 to 18 months. So it's a very significant move, because if you compare current status, I think the figures are 2 billion US dollars are invested by global investors in Indian bond market. So this is like almost 10 times or 20 times growth that you're going to see in next 12 to 18 months. So it's a very significant move, and a very positive story, especially from a foreign reserves perspective, because these funds are going to come into India, and it will add up to the forex reserve that the country has. Additionally, these three index that I said, these are passive funds. So there are a lot of active funds who would also follow this, and there would be an additional flow of money also which would head towards India. So it's a good news, and it's a very positive move, especially from the investors' perspective, also from a government
Yeah.
perspective. It's a thumbs up because it's a kind of acknowledgement that we are there on the global map now.
Yes, and you have kind of shed the light on the numbers quite elaborately. And needless to say, this might make the $5 trillion economy goal that has been talked about a lot lately, and get us a step closer. Don't you think so?
Yes, indeed it would. And to do business, you need funds, and this is a, like, I'm giving you an access to, say, in simple terms, if I say for a common man, you get access to a loan or a credit facility, you can borrow and do business. So you would do it much faster and much easily. So in the same way, when we get included in the global indices, the government's cost of borrowing would go down. And that would also have an impact on private sector's borrowing. So one, you get access to credit, not that we didn't have, but the cost of funds were higher. So now that we are formally included, it's like a stamp, and you could say a better credit rating kind of a scenario where you can borrow at a much cheaper rate, both the government as well as the private sector. And this would really fuel the investments and the borrowings that happens, whether it's infrastructure or whether it's any public sector investment that are there. This would really fuel our dream of reaching that $5 trillion economy.
True.
And it's a very positive move.
Yes, and also in the light of all foreign investors lately eyeing India, it definitely could not have been timed better. Now, moving on, I want to ask you another question. Could you also elaborate on the potential repercussions this inclusion might have on India's export sector and its competitiveness in the global market?
So that's again a very valid point. So when more inflows of fund comes, there are three things that get affected. One, as you rightly said, the economy would grow. The second is your export sector. So export sector would be benefited from this move, as we say that if you want access to credit, you would get access to credit. However, there's one catch in this. If say, for example, I'm exporting, say, IT services in US, and if the US government gives me, say, 4% interest rate, and maybe the Indian government gives me 3% interest rate, I may want to hold my money in a foreign dollar account rather than holding it here. So maybe many exporters, rather than bringing the money back due to this impact, the yields would fall. And we had seen that yesterday in the bond market. From 7.4, it went down to 7.08%. So the Indian yields are going to go down. So maybe exporters may not bring that precious dollar, but that shouldn't be a worry because they can't hold it for a long time. But overall, this would be a very good move for them as well, because they get that line of credit in trade finance, as we say, letter of credit and other access to funds. So much cheaper access to funds, and this would really boost them from getting that access to a crucial supply of money for doing business. So this is a really positive move even for the export sector.
It is indeed, and also a very keen time for all the market watchers out there. Thank you so much, Mr. Bhatt, for joining us and taking some time out.